institutional investors have been spoiled in having access to the best returns, the best managers, the best opportunity sets, and they have had it to themselves for decades. And it is very uncomfortable to have to now share what you've previously had all to yourself. Like, let's be honest, that's what this boils down to, right? If we were to boil this down to a single sentiment, I would say bluntly, it's a sentiment of entitlement.
Hi, this is Matt Pauker with Wendy Lee. We're co-founders at Ivy Invest, and welcome to this week's episode of The Investment Office. This week, we're going to kick off talking a little bit about a piece that was put out this week by ILPA, which is the Institutional Limited Partners Association. It was a really interesting piece that touched on several topics that we've covered here over the last few weeks on the Investment Office. Specifically, it shed some light, I think, on how institutional investors, the kinds of endowments and foundations, Wendy, that you used to work at, how they view this almost stampede of investment managers now targeting retail investors. And this is something, Wendy, you've talked a bit about how you had perceived that a lot of institutional investors might think about this new trend. And I think it may have validated a lot of how you thought folks would react. I'm curious what your initial take was.
Yeah, that's actually spot on. When I saw this report from ILPA, it reinforced a lot of both my own suspicions as to what has been underpinning a lot of the objections toward retail investors investing in alternatives. And it also made a lot of sense to me. So what do you mean by that is my initial reaction to seeing that report was, oh, this was a long time coming. Eventually, the pushback from institutional investors was going to come, not in the sense of retail investors need to be protected and need to be on guard for all of the potential downsides for investing alternatives, but instead it's okay, now this is capital that's competing against ours as LP capital into the same types of GPs that we invest with. And so for me, I was not surprised to see this come out in the sense that I've long suspected this was ultimately going to be the tension. What I was surprised at was just how very clearly it laid out all of the sort of under the surface objections that folks have been sort of saying behind closed doors. And there's a part of it where, of course, as somebody who had been an institutional investor at endowments and foundations for so long, for 17 plus years, I completely understand where all of these objections that ILPA has laid out, all of these objections are coming from. In fact, when I was most recently at Mother Company Health Foundation, when some of these retail products were first coming out, this was also my knee-jerk reaction. My knee-jerk reaction was very much, okay, well, I question the quality of these retail products, very quickly followed by, wait a second, now if this really is successful and there is a lot of success in retail dollars coming into these markets, that's going to be capital that's going to compete against our institutional capital. So I wasn't at all surprised in the sense that my own knee-jerk reaction when this trend first started happening while I was still at a large institutional investor, that was also my initial reaction. Immediately, you go to what are the long-term implications for multiple types of capital competing for the same types of investments. And so I think it was only a matter of time before we saw these tensions come out into the open. And it was, I suppose, a question of how long it might take and the severity of the objections. But I think what we're seeing here in this ILPA piece is that this is that time.
Yeah, and I want to dive in more to some of the specific issues they raise, which I think also go back to some of our earlier conversations around incentive misalignment. But maybe before we get into that, and we'll post a link to the full ILPA piece so folks can read it. But before we get into that, I think maybe worth a little lay of the land just in terms of what this shift really represents and how things used to work. Because, right, I think historically, as you look at funds that invest in alternatives, whether it's private equity or private credit or real estate, these funds historically only raised capital from the kinds of institutions that you were at, these large foundations, large endowments, pension plans, etc. And so the dynamics were, I would say, probably a little simpler, right? These were sophisticated investors operating on very long time horizons. These were products broadly that had been around structurally for decades. But now, as these funds have been trying to reach a broader audience, retail investors, often who are working with financial advisors who are obviously much less wealthy and have much less liquidity than a large university endowment, these funds have been building new structures that look a little different, or in some cases look a lot different than the kinds of fund structures that, Wendy, you historically invested in. And it seems like a lot of the potential issues here that ILPA is raising, a lot of them stem from the differences in these fund structures and probably ultimately the differences in how these two classes, institutional investors versus retail investors, how they kind of behave as investors.
So the interesting thing is that institutional investors now are grouped together as one class of investors. But before we really had this dialogue of institutional versus retail, institutional investors themselves are not a monolith, right? So there actually are really big distinctions between what matters to different types of institutional investors. An endowment or foundation, even a small endowment or foundation, might differ from what a large endowment foundation cares about. An endowment foundation might differ in terms of what they care about versus a corporate pension plan or a public pension plan. And so the LP types across institutional investors have always had some degree of competing interests. And this is something that is now sort of being put aside. And because regardless of all of those differences, they are still more alike than not if you look at institutional investors now versus retail and wealth capital, right? And so all of a sudden, it's all of those differences are getting brushed under the rug. And the much bigger gap now is between what do institutional investors care about versus retail and wealth investors. And so that is, just to put it out there, it's not like institutional investors ever unanimously agreed on terms or what was important to each of us anyway. But all of a sudden, this has become like a unifying force because there's like, oh, this other pool of capital that is so different. And so one of the things that you mentioned, which obviously bears highlighting because it has consequences for all of the other things that make the investors and what they care about different, the structures that you referred to, right? So institutional investors have always invested into private markets through what are known as drawdown structures. They tend to have, we've talked a little bit about this before, these structures are limited life. They might be 10-year fund lives with some number of years of potential extensions should the investors agree to them. They, within that 10-year fund life, maybe the first 5 years were considered the investment time period for that fund, meaning that fund can make new investments in that time period. And during that 5-year time period, the manager can call capital at any point in time. So an investor would agree to make a commitment of a certain size to this fund that would be called down predominantly in the first 5 years of that investment period. Remember, these are all sort of hypothetical timeframes, but generally fairly common. And then over the course of that 10 years, eventually the fund will start to return capital to those investors as investments are realized. And so it's this dynamic where these funds are locked up. Capital, once it's drawn, is locked in. The investor doesn't necessarily have a window or visibility into when capital will be called, how long it will stay invested, when it will be returned. And in those intervening years, for that entire duration of that fund life, that investor has to be comfortable with having no say over liquidity, right? And institutional investors who have been investing through these drawdown structures are very familiar with the mechanics. We've talked about how the mechanics themselves just take some getting used to if you are new to investing in private markets. And so in order to bring private market investments to a broader audience, to retail and wealth investors, the idea that these investors who are unfamiliar with drawdown structures should need to familiarize themselves and master the mechanics of these drawdown structures was just too high a hurdle. So what we've seen now in response to this interest in expanding the investor base for private markets is that managers have had to innovate on the structures through which they offer their strategies. And that has led to this proliferation of evergreen structures. And so these evergreen structures, they help bridge that gap because if you think about the differences between institutional investors and retail investors, as you noted, Matt, retail investors have lower amounts of capital to invest. They may not be able to withstand the same degree of illiquidity that institutional investors can, and they, like I mentioned, are not familiar with mechanics of drawdown funds. And so these evergreen structures are built to meet the needs of this new class of investors looking to invest into private markets.
Right. It makes sense as an individual investor myself, and certainly, obviously, we run an evergreen fund ourselves here at Ivy Invest, but as an individual investor myself, and somebody who has had some exposure to drawdown funds, like managing capital calls is a pain. And the fact that you invest dollars, and particularly for certain kinds of strategies, you don't see really any dollars come back for a very long time. And like you said, you're locked up again. It makes total sense that these funds would build new products for individual investors. But what I thought was so interesting about this ILPA piece was perhaps things that I hadn't thought of, having not been an institutional investor myself. They highlight all the potential negative consequences for the existing institutional investors. I thought chief among them, and you've talked a little about this, Wendy, is often simply that individual investors don't expect the same kinds of returns, right? An individual investor might just be happier with a lower rate of return relative to what an institutional investor would expect. And that could lead to all kinds of interesting distortions.
Yes, exactly. So there's this concept of cost of capital, right? We've talked a little about this. It's one of the things that I think very deeply about when we invest in the managers that we invest in here at Ivy Invest. It's this concept that if the fund or strategy is looking to meet a certain return, the higher that return, the more discriminating a manager hypothetically might be, or perhaps they would take on greater risk to achieve that type of return. And so in order to do that, you would want to make sure that your investors are cognizant of the types of risks that need to be taken to achieve that type of return. The higher the required rate of return, the higher the cost of capital for any strategy, it makes sense just intuitively, the fewer opportunities that might exist that meet that hurdle, right? So if you think about it, there's just a lot more opportunities that can deliver a 5% return than opportunities that can deliver, say, a 25% return. Right now, I'm using quite extremes here to demonstrate what I'm talking about. I think the challenge here is that institutional investors have generally over the years come to what I'll call more commonly accepted rates of returns, hurdle rates that are expected of different asset classes. And the question is whether individual investors, retail investors who are familiar only with the types of returns that have come from public markets, what's traditionally been available to retail investors, they may not realize what is achievable in private markets. And so the ask for what retail investors are looking for may not be high enough relative to what institutional investors have traditionally expected of private market investments. And so what I mean by that is, let's say, and this is all hypothetical, let's say an institutional investor looking at buyout private equity. I would say that historically, when institutional investors are looking to underwrite buyout private equity, the expected rate of return is, let's call it minimum 15% to 20% net IRRs, right? And an individual investor might say, well, if I'm getting on long-term averages, getting 8 to 10% in public equity markets, I might be happy with a 12 to 15% net on private markets. And so all of a sudden that differential means that the structure, the vehicle that is serving individual retail investors doesn't need to be as discriminating because they only need to meet a 12 to 15% hurdle, again, hypothetically speaking, right? And for institutional investors who continue to hold private market investments, private buyout investments to a higher hurdle, to a, let's call it 15 to 20% net return, all of a sudden that manager might be looking at a type of investment that would not meet the returns for institutional investors, that might meet the returns for a retail-oriented vehicle that has that lower cost of capital that we referred to. And so that is, I think, a very valid concern. In fact, I believe that that actually is a thing that occurs it's actually something that we're very cognizant of in the types of investments that we make, precisely because there is a demand for that retail evergreen structure that is lower return seeking. But that doesn't mean that all evergreen retail structures will necessarily be lower return seeking. And so I think what is concerning to institutional investors, and this makes sense, is, well, how much of a GP's sourcing and efforts and diligence now are directed toward feeding the beast, let's call it, of retail structures that may be raising a lot of capital. And so if retail capital starts to become a larger part of a firm's overall assets, does more of that firm's attention then turn toward meeting and finding investments that only need to meet the return hurdle for that retail vehicle? Does that manager now have the same discipline to continue looking for returns and investments that can meet that higher return hurdle? And so again, I totally can appreciate where this concern is coming from, but I also think it is minimizing the potential value of these evergreen structures for retail investors who don't necessarily require the same rate of return. And that is okay, right? It just is a question, I think, more importantly of, and there's sort of two sides to this. There's a nuance here. From the institutional investor side, it is, does the manager still maintain and commit to finding opportunities that are higher return seeking, that meet the institutional return hurdle? And then for retail investors who are more discerning, who don't necessarily set a lower return hurdle for themselves. And this is, I think, where we, with our IB Invest hat on, care a lot about generating institutional type investments and returns for our retail investors. It's also important, and we see this, there are certainly evergreen structures that do pursue institutional level hurdles of return. And so I think like that's a nuance that exists in the market as well.
That totally makes sense. At the end of the day, I think there are a lot of people, to your point, who would be happy with a 12% return versus an 8 to 10% return, and we shouldn't cut off the nose to spite the face, I guess would probably be one way to think about it. But I think your other point is a good one, which is these firms do have limited bandwidth capabilities, and I wonder then, do you envision in the future that maybe the market just gets bifurcated into firms that tend to focus their efforts more on retail versus firms that tend to focus more on institutional clients? Or do you think there are firms who will be able to kind of navigate the bandwidth constraints of both?
In some ways, what you're asking is what currently exists, right? There are a subset of firms whose clientele is primarily retail investors, and there's a subset of firms whose clientele have historically been institutional investors, right? So that's like, you're describing the world that currently exists.
Right.
What we're entering into is a world in which the firms that have historically served institutional investors, can they now also serve retail investors? One, serve the retail investor as well, and two, do so without alienating their institutional investors. Like, I do fully acknowledge like there's an outstanding question here. There are tensions between retail and institutional investors, rightfully so, because I think to some degree, institutional investors have been spoiled in having access to the best returns, the best managers, the best opportunity sets, and they have had it to themselves for decades. And it is very uncomfortable to have to now share what you've previously had all to yourself. Like, let's be honest, that's what this boils down to, right? If we were to boil this down to a single sentiment, I would say bluntly, it's a sentiment of entitlement, where institutional investors, because they've had exclusive access to themselves, now don't want to have to share. Because the challenge, and this is and I fully acknowledge this is a very real downside. It's a demand and supply issue. Now that there is greater demand for the same types of investments that previously were reserved only for institutional investors, there's more capital, right, pursuing that. But the supply of managers doesn't necessarily change. It does suggest that institutional investors may no longer have the same bargaining power that they've been used to having, may no longer be able to have the same hold over what priorities a general partner or manager sets. And that is uncomfortable. And I think there's going to continue to be this tension. And there may be a subset of managers who says, you know what, I don't want to alienate my institutional investors. I am going to stick to exclusively having an institutional investor base. And there's going to be another subset of managers who will say, I'm going to try and navigate this. I realize there's going to be tension between my subsets of investors, but candidly, that tension has always existed to some degree, like I mentioned earlier. There's always been tension around the different types of institutional investors as well. A $1 to $5 billion endowment never have the same necessarily priorities as a $300 billion public pension plan, right? We often invested in different managers as a consequence of that, and you may see something similar happening, but it's hard to say because I think we're just in these early days of navigating these tensions.
Do you think that this actually leads to fee expansion, right? I mean, historically, over the course of financial markets, we tend to see fee compression, right? Which is that as more competitors come in and offer similar products, fees go down, right? You look at what the fees are now on passive index products. It's almost zero because so many people offer the same product. But to your point that there are only so many compelling, for a given rate of return, private markets opportunities available. And if now there is more capital that is seeking those opportunities as retail capital floods in, do you think it actually leads to fee expansion here and gives the managers, the funds, the ability to at least maintain, if not increase, the fees that they charge to investors?
I don't necessarily think that's going to necessarily be the case. I mean, to some degree, you already have that in certain strategies. For a while, these multi-manager platforms, I'll just use this example, these multi-manager platforms for hedge funds have seen just egregious increases in fees and pass-through expenses. And so long as there is a supply-demand imbalance and the returns are really good, folks might be willing to stomach that to a point, but as soon as returns don't meet and justify that anymore, you just see a very rapid backlash. I don't think that that's a sustainable way. Investment management, particularly on the private market side, is a really long-term game. You're not looking for investors to invest with you for one vintage year, for one fund. You are ideally looking for investors that will stay with you across multiple funds. So I don't think it is going to lead to a situation where managers start to become short-term oriented in terms of the LP base, investor base that they cultivate. And so I don't necessarily know how the tensions will be resolved, but it would be surprising to me if it were simply a let's just raise fees for everybody and make it less palatable for everybody. Because markets turn. Any manager that has been doing this long enough will understand that any short-term gains from an escalating fee game will ultimately alienate investors in the long run.
And the point you made around markets turn, one of the other things that I thought was really interesting about this ILPA piece was the number of times they talked about headline risk as it relates particularly to when markets turn and some of these retail funds may run into trouble. And this is something I've heard you talk occasionally, Wendy, about headline risk. Maybe you could expound on that a little more and how LPs historically think about that and why some of these managers may present headline risk in, say, down markets.
Yes. So the headline risk that I've always referred to actually is a slightly different take on it than I think the headline risk concern is for retail investors. So institutional investors, or at least the endowment foundations that I've previously served, those organizations are concerned about headline risk in the sense that the institution does not want to see any of its managers out in the news doing something inappropriate. You don't want to see your manager out in the news for having gotten pulled over for, again, making things up, a bar fight, right? So those are the things that institutional investors are concerned about. They don't necessarily want to see their manager in the news for something that displays poor judgment. Let's put it that way. Where I think the headline risk concern stems from for retail investors is much more along the lines of manager has a large retail investor base and that manager underperforms or markets decline and the manager has a lot of outflows and the manager is not able to give retail investors their capital back immediately. We saw this with some of the large private REITs meant for retail investors in recent years. That type of headline risk can potentially be really challenging, both for the firm and for the other investors who are still staying invested in the firm. And it can just be a really massive distraction. And so that's what institutional investors are concerned about is if a firm has to manage the fallout in the headlines, in the public view, in public opinion, and deal with that type of distraction, it takes away from their focus on the investment side. And so I think it's more, does having a large retail investor base open a manager up to potentially having more of these distractions?
So much of this, to your point earlier, feels just like the institutional LPs saying, hey, it's kind of like they were the only children, and all of a sudden the second kid's on the way.
There is, oh my gosh, I'm laughing because that actually is such a hilariously apt description. Also, like, totally.
The toys are going to have to get shared.
Oh my gosh, I don't know where to go with that. I think this is where we end it.
I think we've exhausted this topic. I suspect this will not be the last time, as always, that we talk about this, but you were prescient here, Wendy, I think, on foreseeing that some of these concerns from institutional LPs would eventually bubble up, and now they have, and I think it'll be interesting to see in particular how the fund managers respond and how this all evolves from here. Well, thank you all for joining us this week on The Investment Office. We'll see you next.